G'day expats and welcome to another episode of Expat Chat, episode 90 today. And I'm joined with my co-host, Mitchell Kelsey, who's also in the Gold Coast office with me, one of our APAC specialists. G'day Mitchell, how you going?
Hey James, doing great, thanks. How about yourself?
Yeah, good mate. Very good. We're running through this year so quickly. It's hard to believe that we're pretty much at the end, the pointy end of July, and there's a lot going on around the world at the moment. Plenty going on with interest rates and what the future holds. It's definitely creating some wish-washy waters for the share markets. But mate,
Agreed.
finishing off the week well. How's your week been, mate?
Yeah, it's been good. It's been good. Busy. I was at a conference yesterday, so it was a couple of really good presentations that I sat in on there. I think there was five in total, common themes that investors are seeing at the moment: inflation, active versus passive investing, all the good stuff. So I thoroughly enjoyed that. And
Yep.
yeah, headed into the weekend after today.
That's it, mate. And for those that are tuning in today, Mitchell also hosts one of our other podcasts, the Atlas Weekly Recap. So that episode will be coming out next week. Today's topic that we wanted to discuss for all our listeners is repatriation considerations. So I've noticed probably a recent theme. I've had a few inquiries come through and a few people looking to return back to Australia, whether they're in the US, Singapore, Thailand. And we want to deep dive a little bit into that conversation that we're having. And I guess some common considerations and things you need to know before you come. A lot of it, I reckon, comes down to timing, timing certain transactions to set yourself up for success and just minimize tax impact. So wanted to discuss that with Mitchell today. Before we jump into it, to our listeners, quick disclaimer: anything that you hear today or are watching on YouTube is purely for entertainment purposes only and should not be construed as any form of personal tax or financial advice. If you do need tax or financial advice, please do reach out. We can put you in touch with one of our advisors or Ben Turner, who is the director for Atlas Taxation Service. But let's kick into it. Repatriation considerations. So, I mean, Mitch, when we talk about that, I think you can look at all the different assets that a lot of our clients have.
Mm. Yeah, so why don't we start off just looking at some more simple assets, even if we just look at cash. I mean, even cash can sort of create a bit of confusion for Australian expats that are, planning to come back to Australia, or even once they've arrived back in Australia, that they might still have some overseas currency. So understanding, I guess, maybe some of the tax implications of, I guess, converting that currency into their local currency.
Yep.
So for the most part, as an Australian expat living overseas, you're a non-resident for tax purposes. If we're sending money back to Australia, there's not necessarily any tax implications as part of that. But certainly if we are, if we are back in Australia, we hold a foreign currency. If we're beginning to transfer, USD, euros, pounds, back from that currency into our local currency, Australian dollars, there may be some, I guess, some tax implications as part of that. And usually they sort of fall under, I guess, the capital gains tax rules. There's some other sort of complex taxation rules. James, we've talked about the taxation of foreign accounts, the TOFA rules.
Yep, that's right.
So for the most part, like unless the Australian dollar has really sort of strengthened it against that overseas currency that you still hold overseas since you've come back, the tax implications for the most part are going to be minimal.
Yep.
Sorry. But still something to think about, like when you are transferring those funds back, that you need to be conscious of the tax implications. So, it may make sense to look at, repatriating some of that cash in anticipation of that move. And I guess that sort of aligns with the theme of today's episode, sort of looking to plan ahead for the most part when you are looking to repatriate back
That's
to
right.
Australia.
That's right. And I think if I think back at a lot of clients that have repatriated in the last couple of years, some of them are still holding foreign currency. And the way the ATO treats that now, especially if you've been back in Australia, ordinary Australian tax residents now, well, technically you're holding the foreign currency almost like you're holding a share. So, there would have been a time in which the ATO would have seen you as purchasing that currency, and that would form your cost base based on the FX to the AUD. And then when you're converting it back to, say, AUD from US dollars, Singaporean dollar, pounds, whatever it might be, there could be an actual currency gain that you're making. I reckon a lot of the time Aussies would forget to declare that potential currency gain in their tax return. But technically it is something that's taxable, especially if you're trying to play the long game and hold US dollars thinking it might get down to, 50 cents or whatever it might be, or $1.80 on the other side. So just being mindful of that you can definitely exempt a lot of those future headaches when it comes to timing, and when might be the right time to send it back to Australia, when maybe you're still a non-resident, as an example. But it is tough trying to time that, because obviously you don't want to send back too much and then have nothing in your current home country, and you can't transact and do all those sort of things. So that's a really important one. Cash, currency, when is the best time to send it back? And obviously applying TOFA. Let's move on, I reckon, to another asset class. I'm going to throw it out to us. I'm going to go first off, foreign pensions. Foreign pensions are a really good one. I think the most common one that I come across is usually the US ones, your 401ks, your IRAs, some in Singapore, some in Canada as well. I guess transferring those out can be quite difficult. I'll kick it over to Mitchell here. I mean, Mitch, what do you often see around, these foreign pensions?
Yeah, so for the most part, we do know that, I guess, the ATO understands or acknowledges certain foreign pensions and provides a level of, I guess, tax relief to those pensions. And I guess their definition is a foreign super fund. So if an overseas pension meets the definition of this foreign super fund, FSF, and usually there's I guess a degree of tax relief. But for the most part, a lot of foreign pensions, and namely that there's really only one that actually meets that definition of a foreign super fund, FSF, and that's the UK pension scheme. Most of the others, you mentioned retirement accounts in the US, or pension accounts in the US, 401ks, IRAs. A lot of the pensions we see in Asia, Singapore, Hong Kong, most of these meet the definition. They don't meet that definition of foreign super fund, and instead they're treated as a foreign trust, and that's where some tax complications can arise if we're looking to make withdrawals from these pensions once we're back in Australia. Usually there's a component that is tax exempt, but there usually is a growth component that is taxable as part of making a withdrawal from that account. So definitely just being mindful of that, and probably makes sense if you've accumulated a significant sort of I guess position in a foreign pension. When you are back in Australia, just think twice before you take a lump sum, thinking it's going to receive a huge lump sum. I mean, like looking to take the full balance, thinking that you're going to be provided a good amount of tax relief, because might have a bit of a surprise there come tax time. So having a bit of a strategy in place.
And I mean, to our listeners, a good example. I remember I had a call with a gentleman back in 2019, and he just pulled out a large lump sum out of what's called his Roth IRA. And so for our listeners, that's just an after-tax type of foreign pension in the US, where when they withdraw it, they actually don't pay any tax to the IRS. That's great. However, the ATO doesn't see it like that. It sees it as Mitch just described, one of these sort of Section 99B foreign distributions from a type of foreign trust. So the withdrawal that he pulled out was about $250,000 US. And we had a call, and he said, I need some help with some tax planning because I've pulled this out, and, I just want to put it into super. I've been told I can do that. And after we sort of reverse engineered what he had done, I said, okay, well, are you aware that the ATO is probably, or not probably, will actually treat a large portion of this as income? And he said, oh, no, I wasn't. I thought it was completely tax-free. I was like, oh, okay, well, did you seek some advice before doing it? And he actually said he spoke to an accountant in a bit of a general sort of conversation. and he should have actually sought some professional sort of strategic advice, some written advice that was verified, probably also by a US accountant. But he ended up sort of not being able to do too much with that scenario because the financial year had already gone, and he had to pay it's probably about 30% tax on the total lump sum when you probably work out the effective tax rate. So that was a huge shock for him because he thought initially it was all tax exempt and he could just push it, transfer it straight into super, which is not the case. You know, there's usually not a really good transfer scheme other than maybe the UK system to move the super across. The other one, which I know we've both come across, Mitchell, is if it's, say, a foreign pension, which is, say, a lifetime annuity once it's eventually set up, the only sort of, I suppose, deduction that you can get or apply for with the ATO is what's called an undeducted purchase price deduction. And essentially, you're submitting a private ruling to the ATO to say, hey, this is the makeup of this foreign pension, this annuity going forward. I'm going to receive this kind of amount every year indexed. And then the ATO will provide an assessment for that financial year and say, cool, based on what you've given us, we'll allow you to claim a percentage or a certain amount for a deduction to offset a portion of it for that income year. So that's a really important one. A lot of expats probably aren't aware of that, but that is something that sometimes you have up your sleeve depending on the mechanics of the foreign pension. But again, same again, timing, how's it going to be treated by the ATO? How's it going to be treated in the other country as well? There's a lot that you can unpack with foreign pensions. Absolutely. Moving on to another asset class, property, one of my favorite assets. Property is an interesting one. And I guess a revisit of what Australians used to have back in Australia, main residence exemption, the capital gains tax discount concession. So expats can't access either, especially whilst they're overseas if they transact anything like that. But Mitch, property, selling, timing, what are your thoughts?
Yeah, it's a good topic and a lot to unpack it. And something we did touch on last week a little bit, sort of how is a former overseas property tax for capital gains tax purposes here in Australia. So again, like if if an Australian expat is coming home and they're retaining their overseas property, usually it's a case where there's a deemed acquisition, so you're deemed to have acquired that asset for CGT purposes at its value on the date that you arrived in Australia. And if you're looking to sell that overseas property 6-12 months from being back in Australia, there are going to be some tax implications as a result of selling that property. But as we touched on last week, there are still capital gains tax concessions available to you as an Australian resident for tax purposes. So it might be relatively simple if you just got one property, but we both have clients and know clients that currently have multiple properties overseas, and that's where the tax analysis and the strategy really comes into it, and just having a bit of a repatriation plan is really critical.
Yeah, absolutely. And you hit the nail on the head. I mean, there's a lot of options that can play out. Whether it's timing and sale of the property before you come home, what concessions you can access from the Australian side on the sale of properties in Australia, and then layering that further with, well, what concessions can you use to put more into super in preparation for your retirement, cost-based resetting because of owning a property overseas and then coming back to Australia. There's a lot. It's a minefield, to be honest. And it can fall a lot of different ways. So when it comes to property selling, timing is a big important factor. And that can be the difference between paying no tax versus a couple of $100,000 in tax. I think I recently saw some advice that was given by another firm to an expat, and they recommended they sell a main residence worth just over, it was a significant amount actually. And the advice was very wrong and incorrect. And it would have resulted, if they followed through on the advice, in that expat paying over $500,000 in tax to the ATO. So it just goes to show it pays to seek advice from specialists or professionals that deal with it day in and day out. So that was an interesting one. And that was from an Australian financial advisor in the industry. Moving on to another one. And you and I both have clients which accrue these from their employer, and that's shares, direct equities. I'd say there's a large component of Aussies which get these based on their employers, common forms, restricted stock units, and some sort of employee share option plan. Um, you know, I think zooming out, they've got options: hold them, transfer them, sell them, and then there's a lot of, I suppose, further options off the back of that. What are your thoughts on that, Mitch?
Yeah, definitely. So I think in their simplest form, clients that are afforded these types of employee share schemes, so they've been receiving shares throughout the years of their employment. Usually, initially the shares are granted, which means they're restricted, so that you don't technically own those shares. You can't sell them until such time as they vest to you. So to keep it simple, for the most part, we see a lot of clients that have vested shares in the company that they, are employed by. Coming back to Australia, very similar sort of tax treatment as real estate assets. So similar sort of deemed acquisition at that point in time. And similarly, again, the same sort of capital gains tax concessions are available on those types of assets. But with that, again, there's a whole range of different planning opportunities as well. For example, the 50% CGT concession that we have here in Australia, the rules with that is you need to have owned that share for at least 12 months. And that sort of 12-month counter doesn't kick in until you've actually arrived in Australia. So you're selling shares, 6 months after you've arrived back in Australia. That 50% CGT concession isn't necessarily afforded to you. So that's just one example of just planning for, and just extends to shares generally as well, not just clients that have stock in one particular company as part of their employee benefit, employee sort of stock plan. But yeah, definitely a range of planning sort of opportunities prior to coming back.
Yeah, absolutely. I mean, I get excited around the tax planning opportunities that you can really roll out for expats, especially when they're returning back to Australia. Timing is obviously a key factor. The right tax structure is a key factor as well. And there's always a bit of an overlap between starting residency and moving some of those shares around. A lot of the time, if you're coming back and you're holding a single share as well, that's a huge risk to yourself because you're going to be riding the emotions. A common one that we talked about 2 years ago, especially when COVID-19 hit, we had the big market drop, and then you had 2022 hit, Russia-Ukraine crisis that went off. You've got a lot of expats that are employed by those tech companies, and they're still exposed to a single stock. And you had people's wealth halving, in a matter of days because that's how quick the share market fell. So that's also the importance of divesting out of one stock and then diversifying into, a diversified balanced portfolio where you might have exposure to many markets, many, different industries, and that helps obviously reduce that volatility. So I think that's been a really big one I've seen over the last couple of years, that people are now listening out and going, crap, I need to start considering that. What's the best way to do it? But yeah, when we look at the wealth that's accrued through a lot of those kind of holdings, for a lot of expats through their employee share purchase plans, RSUs, those sort of things, having a plan when you come back to really minimize your tax exposure, it's just, it can really fast track your wealth.
Yeah, and it just so happens like a lot of those companies that do offer those stock plans, they do tend to be the tech companies because, for the most part, a lot of them aren't necessarily making a profit. So they don't have the cash flow to offer these, huge salaries, and the stock is a form of remuneration. So, and as we saw through that 2020, 2021 period, the technology sector, some of the share prices just went, nuclear through that period. And
didn't they?
It just had a lot of people, bit of analysis paralysis, just sort of holding long and sort of, they were worse off through 2022 just due to inaction, I guess you could say.
Yeah, I agree with that. And I think you and I have talked about it before. 2021 was the year of easy money. You at the start of 2021 or December 2020, you could have thrown you could have thrown any money at any kind of tech stock in the US market or Australian market and probably returned 25%. Q 2022, those stocks are declining and, capitulating by 35%. So all those investors which did well through GameStop and all those sort of things, wasn't a hard market to make money, but it's now a very hard market to make money. And all those kind of overnight investors are now left throwing their hands up going, crap, how do I navigate this space? So I know that's a really important one. Other repatriation consideration I would say is as you're looking to exit out of a country, just understanding sort of what's going to happen to your banking when you leave. If you're changing over your address and it's an Australian address from the US address, is that going to reduce your ability to transact on that account? So all those little intricacies from a life admin aspect, all your subscriptions you might have set up, all those little things, credit cards, closing them out. A lot of the time people often forget to do that and they try and do it once they're back in Australia. And then also just having a fundamental understanding of, okay, well, I've been employed in the current financial year in this country for 7 months. I know I've still got to do a tax return. I'll just do a bit of research in how that's taken care of. Do I do it now because I'm leaving, or do I just still wait until the end of the calendar year or end of the tax year? And have I got, the means to do that, or do I need to get help? So just those little things which I often find we often forget about.
Yeah, it's a really good point. And definitely, trying to open a bank account from another country, for example, if you're trying to reopen a bank account in the US and you're in Australia, good luck. It's not easy. I've seen a lot
It's
of
not.
clients sort of have difficulty with that. And yeah, I mean, especially if you're, for example, staying on the US, if you comes time to get your US Social Security payments, want to have a US bank account for that. If you're, still filing a tax return in the US for any sort of refunds, might be good to have a US bank account. So yeah, definitely a good admin tip for sure.
Absolutely, mate. I think we might wrap it up there for today's topic. Mitchell's been obviously sitting in and replacing Brett for the last couple episodes. Brett might be back on deck after a bit of leave next week, or we might kick him to the curb and not let him back in. We'll see. Look out for the next episode. In the meantime, Mitchell, thanks for joining me on today's episode, and thanks for tuning in, guys.
Thanks, guys. Appreciate it.